right, we're going to go ahead and turn this over now to Ben and get started.
Thank you. Welcome, everybody. Normally we do this presentation in February-ish, but we held off, I guess, because of COVID. And so now we're presenting from home. So we've done a few of these in recent months. But just so everybody knows, I've got two four-legged coworkers that sometimes come around whenever the mailman comes by or UPS comes by. So bear with us with that. Just a short introduction for us. So I'm in charge of the tax controversy and procedure for Eide Bailly, and Margarita works with me in my department. So we are two people you can contact. We have several in our group, total of 9 right now. Cover all the controversy issues, and we can help with federal or state. So that's kind of our background. Let me make sure I've got control of the slides. Today we're going to go over, well, I'll give you just a little bit background on myself though. I'm an attorney by training. I'm also CPA. I've worked for law firms in the past. I spent 8 years at the Office of Chief Counsel for the IRS, covering all different areas. At first I worked in SBSC, then LB&I as an STA, a special trial attorney, working on large cases for the IRS. And did a lot of collection, and I was also a bankruptcy SASA and did everything they asked me to do. So that's kind of my background. I'll let Margarita explain hers when she gets to her part. But today we're going to try to cover, as we do every year, kind of what's going on with the IRS and give you some help, some updates and help for handling IRS exams and how to go through the appeals process, mostly to trigger some questions, give you a little bit of tidbits or tips and tricks. But we're going to discuss the current audit issues first of all, kind of what the hot topics are, and then we'll go through how to deal with those exams, and then how to go through appeals or possibly negotiate with chief counsel. Then we're going to throw in a little bit about some collection issues that are hot topics right now that have come from recent changes in tax law or suspensions of things, and a little bit about the new partnership audit rules, since we get a lot of questions about that, and there's a lot of, it's new to the IRS and us, so it's a developing area. So I'll let Margarita kind of introduce herself and talk a little bit about what the IRS has been up to. Now, all these statistics are dated because they don't release them till a year after they happen. So.
All right. So my name is Margarita. I am an attorney as well, and I've been kind of doing collections exams for the past 13 years. I'm newer to Eide Bailly, and I am a manager with the tax controversy group working with Ben. So I'll just kind of jump right in. So statistics regarding IRS audit activity. So for 2018, there were more than 195,750,099 returns filed. And just to kind of have a comparison, in 2015, 1,373,788 returns were examined. That was about 7%. In 2018, that number declined. It was 991,168 returns were examined, about 5%. And then we have a breakdown by kind of category. So they categorize audits by field audits. So those are audits by revenue agents. That was about 250,000. Correspondence audits is generally just audit by mail. That was about 741,000. Then we broke it down by individual returns versus C Corp, S Corps, and partnerships. And you can see that essentially the numbers were higher in 2015 than they were in 2018. But the IRS did hire more agents before COVID-19, so we do expect those numbers to go back up. In 2006, here's a breakdown of, so as a result of the audits or exams, there was proposed tax of 44 billion, and 24 billion was unagreed. 2015, that number went down. It was proposed tax of 25 billion. 7.4 billion was unagreed. And in 2018, that proposed tax of 26 billion, 10.1 billion unagreed, and 6 billion additional refunds.
So just a little bit. So yeah, this 0.5% that they, so that's down from 0.6, 0.6%, so way less than 1%. We use the 2006 as a benchmark just because that's the first year I worked for the IRS, and that was, look kind of like a high watermark. Now they have a lot of, they're proposing less, which, I mean, you could interpret that as could be reasons for it. Maybe everybody's reporting correctly, but but it's more likely that they're just getting to less returns and making less adjustments. But.
Okay, so we have our first polling question. What percentage of returns were examined in the IRS 2018 tax year? A, 1.3%, B, 0.6%, C, 2.21%, or D, 0.5%.
So that first poll is open. You should be able to click within the box and submit your vote.
Yeah, what was interesting is this polling question, I didn't have to change. I had an answer in there and didn't have to change it, just had to change the right answer. But it was a downward trend. So, I mean, there's lots of explanations for it. I have personal feelings about how the IRS is working, but as we'll talk about, they said that they're moving more to campaign type issues instead of, total coverage of returns, which would allow them to focus more. But you would think that that would be a trend to more adjustments. But as I noted in the previous slide, they actually have an increase of total refunds issued. So maybe tax preparers are just not reporting correctly, but in the taxpayer's favor.
Had 40% of the vote as 0.5%.
That was the correct answer.
Okay, so what is the IRS tax gap for 2018? So the gross tax gap is the difference between the true tax liability for a given tax year and the amount that is paid on time. So this would include non-filing, under-reporting income, and underpayment, 181 billion. And then out of that, the individuals was 245 billion. Corporations, 37 billion, publicly held 28 billion, 47 billion.
So the tax gap is important because it's what they use, the IRS uses to measure like how well are they doing, because they can't get to everybody, of course. So they're trying to, for lack of a better term, scare people up so that they're reporting correctly. But this is the number they calculate. Now, I used to go through, when I was with the IRS, a group of people that helped calculate this for our region. And I've always felt we way undercalculated. I mean, it should be double. Just by the employment tax alone, I think is understated. But they get to come up with the numbers. But it's basically, this is just they take statistics out of the audits that they do accomplish and try to come up with this number. So, whoops, sorry, I went too far. Okay, so what is the IRS auditing, right? Or since they've changed their focus to just randomly pulling returns, they've moved to these campaigns. Talk a little bit about the campaigns. So first, I'll tell you a quick story. So I was always curious as to I'd get a whole bunch of cases that were seeming meaningless and where the agents were just like saying you didn't provide enough substantiation, and then we'd look at it and see what was real and come to a conclusion when it came to us in chief counsel that usually was far less than what the agents had written up. So yeah, I always wondered then I'd get cases where they didn't notice or didn't hit the real issues, and I'd address the issues in the case in tax court, and I'd always say, well, why didn't they do this? And I found out there was a lot of idiosyncrasies with the IRS. Like an agent, even if they found an issue, couldn't deal with that issue unless they were trained. So there was a lot of agents dealing with cases that weren't trained on flow-through entities, so partnerships or S-corps. So even though they could see there was an issue, they weren't allowed to address it. Things like that happened. And so I found several times I'd find cases where clearly this, there was a problem with one taxpayer, and if you just looked at the preparer, you could see that you can pull up all the returns prepared by that preparer. You could see you had the same issue. And I would go and say, well, let's add these to the audit. And they'd say, no, it wasn't part of the audit plan. It's a predetermined plan, and it's hard to change, even though you had clear issues. So that just gives you kind of an example. There's a lot of bureaucracy with the IRS, but they focused on these campaigns where they're asking even practitioners, what do they see as issues? Asking the agents, what do they run into? Supposedly it's to catch that sort of problem where they're focused on something else, but they're seeing other things and they wish the IRS would address them more. So these are the campaigns that these are the ones that have recently been published. So the captive insurance issues, that's still an ongoing thing. We see quite a bit of those. The IRS has a lot of problems interpreting which ones are bad and good. The conservation easements, both syndicated easements and non-syndicated easements, those are heavily audited. We see quite a few of those. The LB&I campaigns, and I'll go over those too in more detail, but the LB&I campaigns are also the Section 48C energy credits, and that's also all energy credits. We see quite a bit of audits related to those. The 48C, I think that's basically the LB&I goes and checks to make sure that it's from the allocated, the Department of Energy approved credits, amongst other things. Then there's related party transactions. This has been, I hadn't seen it when this started, supposedly a year and a half ago, but I'm starting to see more of these that are picked up for that situation in LB&I cases. Sometimes it's sort of the way they find them doesn't make sense to continue the audit, so they quickly get over that issue and they move on to other things. Because even if the audit is about one of these campaigns, they still have sort of a checklist of things they have to visit. So oftentimes the audit will go somewhere else, or they have what's called an LUQ, a large, unreasonable, or questionable item, and they'll expand through that. Basket transactions, I don't see that as prevalent. It was happening when I was part of the IRS. I saw quite a few of these. I haven't seen much, at least with our clients. It's where you are buying these basket of assets from someone that, that's an investment type company, and it's essentially a way of turning ordinary income, dividends or what have you, into a capital gain. So I'm sure it could still be out there, but I haven't seen it as much. The Shea case issues, the complete contract method. I've seen a couple of these, but most people I think follow these rules now since these cases, so probably not as big of an issue. The TEFRA linkage plan, which now there's not TEFRA really, but this is a way to increase partnership audits, where they were saying, well, if we pick up a taxpayer, we need to link through and find their flow through entities, make sure that they're audited, so that there's not additional time to go hunt for a separate partnership return. And we had instances where they would pull up a downstream or upstream partnership while we already had an audit going on from a completely different agent, and we'd always have to point them out and say, well, this is silly, you should just audit it as part of the ongoing audit. Now, yeah, S-corp losses claimed in excess of basis. This goes along with all these basis audits that they have, and they're going after the shareholder loans and different essentially related party transactions. All the international audits, and this is expanded. I didn't list this here, but I should have. So since OVDP has gone away, and there's been more of an expansion into when people were still in OVDP, but opted out or were pushed out, and so now they're being audited for that. All the typical international things that always existed. So just some other areas that are high probability. Research credits. Now, I listed these things. These are what they said they were going to go after. But I think what's notable here is we're seeing the R&D credits get audited more from starting all over from the beginning. When I was with the IRS, we sort of worked out a plan and with different experts on the IRS side and not chief counsel side, and we kind of figured out what was good and what was bad. But now they've hired a whole bunch of new experts, which are really agents promoted to a higher grade for a temporary position, in this area, and they're not that experienced in R&D credits. So to me, it's like we're starting over with them. They're denying things that typically had been allowed by other agents, and then we're having to go in appeals to fight them out. So to me, it's like an education process for R&D, because whenever the IRS selects new groups of supposed experts. Transfer pricing, always still something on their radar, but usually only when it's audited for something else. And then the high net worth individuals, they still say they're going to continue the plan to have all of them audited eventually. So a couple more campaign examinations from SBSC side. The partnership characterization of income, this is very similar. This is, a lot of partnerships will pay a lower salary to one of the partners, and typically you're not supposed to do that in a partnership. They're not supposed to be an employee. So the IRS will come in and say, all this income is subject to self-employment tax, and change around what you can or can't deduct, or what's deductible from self-employment tax or not, like typical benefits like insurance or medical and things like that. So that's very common. We see that quite often. And the self-directed IRAs, we haven't seen as much, but I still know these are ongoing. And this is usually a trap for the unwary, where you have an IRA that's you turn it into a self-directed IRA, and it allows investing in real estate or a business for which you don't own or are involved in. But what people don't realize is you often have to file a 990T when you have unrelated business taxable income, which means you can't compete with a regular business and have your tax not subject to current tax. So it's kind of creating a disadvantage for them to compete with you. And the UDFI, that's when you borrow money to buy real estate. There's a calculation to determine how much of your tax, the portion that's related to how much you borrowed, is taxable. People don't know that they're supposed to file 990Ts there. So we'll have people come to us and say, oh no, the IRS is auditing us. We didn't ever pay any tax on this. We thought we didn't have to. And they've got all these unfiled returns and has to be fixed. The IP monetization transactions, hopefully those are dying out. The IRS has attacked them in a strange way from my perspective, very sort of random, and hasn't been effective in stopping these, in my opinion. But a lot of people have been duped into these transactions, especially people that are charitably inclined, and they're told that this will work, and they do intend to donate everything to charity, but the way it's set up typically doesn't work, or at least should have been taxed to the charity, and it wasn't done correctly. Then shareholder loans, they usually come up in basis campaign issues, which is the last one. Then reasonable salary, that's kind of related to the self-employment tax stuff, but it's listed as a separate campaign. So quickly, I'll just go over the captive insurance. A lot of people are always interested in this. The IRS requires you to file, if you have an 831B captive insurance company, which is one of the small ones, and if it meets certain requirements, typically has claims that are less than 70% of the premium revenue, then you have to file an 8886 and let them know about it. This causes a lot of problems because the IRS has not done a good job figuring out which ones they think are good or bad. When I was in LB&I, we had lots of audits, not of 831Bs, but 831As, and we think we had it figured out, but a lot of those experts left the IRS, and then they started over in SBSC. And to me, every agent has to be newly educated on this. So the audits are very extensive. The last line is actually not correct. There's a settlement now where the current cases that were under audit were being offered a 90-10 settlement, and your penalties could be reduced depending on what kind of advice you had received from independent tax professionals. So that's out there now. I forgot to update that slide, but still quite difficult because the IRS has limited resources. So often they'll pick a case they want to take all the way to litigation, and because they think it's a good case for them, and it kind of railroads the taxpayer through court, and court hasn't been helpful. We've filed, different motions for summary judgment to try to frame issues, and the courts have always just punted it to trial, which is problematic because you can't afford to litigate those issues at trial when it should have just been a legal issue that should have clearly had a determination. So it's a difficult area. It costs a lot of money to fight these, and you're really pained to fight other people's battles. And the IRS has not helped figuring that out. In my opinion, they should just do a settlement procedure, but haven't done that yet. All right, we got a polling question 2. So when is Form 8886 due for captive insurance companies? I didn't go over, read it too much. It's in the slide. There's a lot of complicated things, and it made it extra complicated when the filing deadlines got extended this year. But I'll just go back over that while you're answering the question. But typically, you need to file your 8886 with your return. So it's typically due when your return is due. But if it's your initial year, you have to file a copy with the Office of Taxpayer, OTSA, I can't remember the acronym description, but it's the OTSA group. You have to send a copy to them your first year. So that's why I have A and C is the correct answer, which is D, because you got it. That OTSA part is within 90 days of the transaction becoming listed, and then C is when the return is filed. That May 1st, 2020, it came from an old date when they first listed these as listed or transactions of interest, and they were required to send your OTSA copy in by May 1st. So conservation easements. So we get a lot of these pitched to our clients. I used to work on conservation easements when I was with the IRS. So I have a lot of understanding in that area and know what the IRS is looking for, what they're going after. It's nothing, this isn't a new game. It's been going on for years. And so there's 2 types. The syndicated easements, those are transactions where you have to file an 8886 and let the IRS know you're involved in it. And the threshold is if you invest $1,000, but you get a charitable contribution deduction of 2.5 times larger, so $2,500, then you have to file. So typically you see a lot of these offered at 5 times or 7 times what you put in, and those are going to be on the IRS's radar. And I'm glad to evaluate and explain to people what arguments the IRS will make, or because the promoters of these will sound very good and flashy, but most of the time it's a simple legal problem for them that they can't explain how they'll overcome. So I'm glad to discuss those with anyone. The non-syndicated conservation easements, I mean, there's nothing wrong with a conservation easement. If the main thing is the valuation. Is the valuation correct? And it's based on this highest and best use of the property valuation, because what you could do with the property becomes the thing that could get you a higher value and get you a higher contribution. So when it comes to the ones that aren't 2.5 times, but a lot of people have farmland or what have you, and then say, I'm going to continue to use it. Most of it's just open space. I want to put an easement on it. I don't want anybody to develop it. And so those valuations come into question. But also there was problems. This is more for older ones, but there were problems with the way the industry was drafting the deeds, transferring these easements, and they were allowing for development windows for, like a cabin or what have you on an easement that wouldn't, out of thousands of acres wouldn't really cause a problem with the easement. But if the windows weren't properly defined, then it could violate the in perpetuity requirement, which prevents a lot of these easements from holding up. So now I'm just going to switch little gears here to kind of explain how the IRS works when they do an audit. So here's an example when it comes back to captive insurance. The IRS has here's this regulation, and the IRS reads this regulation. If you read it, it says defines what an insurance company is, somehow the IRS gets out of this regulation that you're violating the reg if your intent was not, was tax purpose, which is very subjective. But they'll often do this. They'll overinterpret or read something into a regulation to make an issue when oftentimes it's not there. So how do you deal with something like that? It's really a factual fight, right? And oftentimes I explain to people is that a lot of times I'm dealing with an agent who's not a lawyer, and they don't necessarily understand how to read the law or even how evidence would be used, and they just kind of have a gut feeling about something, and they'll talk to people or talk to your taxpayer or you as the client, and you explain things and you think you've explained it well, but they only hear the things they want to hear. So to me, it's this buffering process, I like to say, that so I don't allow the file to just be what they interpret it, because when they're putting together facts, they're just trying to put together a file that will eventually sail on to appeals and probably could sail on to court, or at least to the chief counsel attorney, and this influences the appeals officer and chief counsel attorney, because they oftentimes they'll read those facts as true, and if you don't get those facts in to correct them, then you're doing a disservice. So basically, I keep track of everything that they record. So that's one reason why you want to force things to be written in IDR, so you can make sure that they can't read subjectively into verbal responses. But you also have to ensure that the IDRs respond, forward thinking, so that you're anticipating what the issue is and what they're looking for. So, sometimes painting, they only ask you one question. You might need to provide the additional facts that basically, because they're just trying to get you to say one sentence that then they could hang you on, but really, and that's what they're looking for. But you really should be adding all the facts that, support your position. You can do this at the beginning and the end. Sometimes it's better to do at the end, so you know what you're dealing with. That's why, in the LB&I process, you have this acknowledgement of facts process, which usually doesn't work very well, and the agents don't use it the way it's supposed to be done, where you're supposed to be agreeing on the facts. But you got to use that process to make sure you frame the legal arguments later. So what I like to do is called scope the examination. You don't have much leverage in an IRS exam. The agents have lots of power to basically look at what they want, go where they want, talk to who they want. But they do have time constraints and internal limitations. So you can use some tactics, and I won't go over all of them, but my favorite ones are request complicated legal issues to be elevated to chief counsel. So many times, almost every audit, the agents they don't understand the law. You'd be surprised. The audit guide, I'll even read audit guides to them, or what's written in their own, internal revenue manual, and they'll disagree with it. So sometimes you can ask that issue be elevated to chief counsel, so the chief counsel attorneys can straighten it out and make sure they understand. Best example of this is I had a partnership exam, and the agent was, if people understand partnerships, one way or another, something's going to get taxed, but it may not be when the IRS wants. But so, for instance, you could have it, you could have debt forgiveness income and pop up in a situation where you had a loan, and one way or another, eventually when that partnership liquidates, something's going to happen. But where we had that situation, the agent was trying to tax it basically 3 different ways, and for over 18 months we were trying to explain to this agent that, yes, we had already taxed it this way, you can't tax it again 2 other ways. And finally we got them to elevate it to chief counsel, and after 18 months of dealing with this issue, and he was preparing it to go, to be written up, he came back and said, oh, I'm not going after that issue anymore. So another one is remember your file. A lot of people like to be like, well, defiant and don't want to provide anything more than they have to, but you got to remember what goes in this file is going to show up with appeals, and if the information is not there, nowadays they'll either send it back to the agent when you add information, or they'll discount it because you didn't provide it the first time. Documenting communications, we always follow up in writing. Usually we send a confirmation fax to make sure they're not misconstruing what we say. Moving ahead, substantial compliance is often an argument ignored by agents, but is allowed by the court. And that's where you can prove, the agents will be like, well, you don't have that specific document, you need an invoice for it. Or this example here was a case with the charitable contributions, where they didn't have exactly what was required, but the court said, well, this statute was meant for orderly conduct of business, and they substantially complied. It was enough for the IRS to do their job, and so just kicking this deduction out because of a little error wasn't correct. But oftentimes agents won't accept this, so you can remember that this exists and use it if everything was seemingly done correctly. Sometimes there'll be a reasonable cause in the statute too that allows you to overcome errors, such as in charitable contributions. Again, this often happens too often. There's IRS agents don't understand evidence very well, so they like to deny things for strict, that there's something wasn't complied with, or they didn't have contemporaneous documents. A lot of times this happens with material participation when we create a log. If the log is created from contemporaneous calendars and things like that, that was what is intended as a contemporaneous document. But agents think, well, if the log wasn't contemporaneous, then it's not valid. But I've lost cases as an IRS attorney in court where they adopted things that were definitely, sometimes just made out of testimony. So there's risk there. It's sometimes hard to convince even appeals officers of this, but it is the case. So, especially if the records were destroyed and you had to recreate them, the law is not meant to just punish you because of, slight errors in records. But the other thing is the Cohan rule, which is a famous case that often the agents don't understand. In that case, the court said, well, there was enough information and testimony and other records that we knew that this something, there was an expense. We didn't know the amount, so they had enough evidence to reasonably estimate the amount. So oftentimes this is, it's not even that bad as Cohan. You could have a situation where you just have check copies, but you didn't have invoices, and the agents deny them. But if you went to court, that the judges do not like that. When you're just basically you'd have to testify about every check and what it was for. That's usually enough evidence to get it deducted in court, but the agents and sometimes even chief counsel attorneys won't even look at the documents, force you to take it to court. Polling question 3. Taxpayer must sign a statute extension when a revenue agent requests one in order to go to IRS appeals. We're going to talk about going to appeals next, but first we'll ask this question because basically agents are all the time trying to convince taxpayers that, man, you've got to sign the statute extension or you can't go to appeals. Now that is true. You have to have a certain amount of time on the statute to go to 30-day appeals, but you can also go to docketed appeals, which doesn't require you to extend a statute. And this is really more to benefit the agent than it is the taxpayer. So the answer is false. You don't need to sign the statute extension to go to appeals. You can go to appeals through docketed appeals. It's kind of a trick question, but so let's move on to appeals here. Okay. Yeah, there's 2 ways to go to appeals. That, like I said, you got to frame your issues to get there in the first place. But and I mentioned AJAC here, but it's really not, I guess, not around in that official capacity anymore. But you still have to have a certain amount of time to go to 30-day appeals. But more often than not, I do not like 30-day appeals because it gives all the power to the IRS and allows them to decide when and where things are heard. You don't get any control. For instance, 30-day appeals, and we often can get an extension to 45 or 60 days. to write your protest, but you have to write your protest within that time frame, and it has to have everything you need in it to go to appeals. You still won't see an appeals officer for 6 months or what have you, but then it goes to the agent, and the agent writes a rebuttal, and that's what goes to appeals. I don't like that because it, the agent has spent months and months and months writing up their position, and now we're helping them, we're with the issues they may have missed in the rebuttal. So the other way is docketed appeals. I actually think it's faster because there's a tax court deadline at the end. What happens is you file a tax court petition, and then you go to, once they answer the case, you file your petition, they answer the case, it goes back to appeals. And I think it's better because there's a little more time. You have a little more control of the time. You can extend court deadlines, which gives you more time in appeals in some cases, but a lot of times you're getting the appeals officer to look at these cases faster. They don't, with that time limitation, they're less likely to send it back to the agent, and more likely to look at the evidence themselves. So that process to me is going to end up being better. If you don't settle on appeals, now appeals is a process where I think most appeals officers are pretty objective. I can say that for most of the country, but I'm telling you, in the North Midwest is not the case. We have very difficult times with appeals there. They're very pro IRS and not as objective, in my opinion. But most other places, the appeals officers are pretty objective. As long as you put together your case and write it up well. We do it as an appeals memo. So we want them to see all the issues and address every issue explicitly. We counter all the agent's arguments there. And so oftentimes you want to keep this pretty short, as short as you can, because that's, in most cases, all the appeals officer is going to read. They're just going to read your write-up and whatever the agent wrote up, which can be their lead sheets, and it's not that extensive. They'll kind of skim through it too, based on my experience with the IRS. So you have to make sure it's short and sweet, but gets to the point. So if that doesn't work out, though, you'll end up in with the Office of Chief Counsel and Tax Court. And when you do that, you now have someone that's tasked with finding the right tax. That's the motto or credo of the Office of Chief Counsel. I took this seriously when I was there, and I was tried to be as objective as possible. They have to do their job and gather evidence and make sure that a lot of things where the agents don't do a good job gathering evidence, they will do that first, and they'll review what ends up coming from appeals as their appeals memo, which just basically explains why they came to the conclusion to disagree with the taxpayer. So by then your issues get pretty focused, and I think appeals tries to consider what's called the hazards of litigation, whether based on the current case law out there, whether they would win or lose. But I think that the chief counsel attorneys often understand better the real hazards of litigation, because you read published opinions, you don't know about all the hundreds of additional bench opinions, which are when a judge just rules in a bench opinion, you get a written opinion, but it's not a published opinion. And it basically, a lot of times, they read it from the bench while they're there in tax court, so that, a lot of those cases, or the cases where the judge has kind of forced people to settle, you don't know about any of those if you're just reading the written opinions. But the chief counsel attorneys know, and they know what the judges will hold them to. You can submit more evidence. You have to be able to do that because, you're now dealing with what evidence is going to be in court. So they can't say, you didn't give this to the agent. So if you find something that you didn't find earlier, you can add it. A lot of times if they don't give you a good offer, you can ask for the appeals previous offer. But some chief counsel attorneys don't let you do that. So I've talked a long time. I'll switch it back over to Margarita to talk about penalty abatements.
Okay, so penalty abatements. Basically, there are two types. One is based on first-time penalty abatement, and that's based on your history. And that's the failure to file penalty, failure to pay penalty. And a lot of times we can actually call the IRS to request the first-time penalty abatement. And what the IRS is looking at and what we're looking at is, let's say it's for the 2017 tax year, we need to look back the 3 years before 17 to see if they've ever been late, if they've ever been hit with the penalty before. If not, then we're able to get that first time penalty abated. And again, take a couple of weeks for the adjustment to take place, and then we can see that reflected on the account transcript. Then let's say a taxpayer has penalties for multiple years, we can get the first time penalty abatement possibly for the first year. But then any subsequent years, it has to be based on reasonable cause. So reasonable cause, essentially the IRS wants to see that the taxpayer did everything that they could do. So they exercised ordinary business care and prudence, but for some reason was unable to comply or pay the tax. So, reasonable cause standard is that the IRS will abate or waive reasonable cause exception. Again, any sound reason advanced by the taxpayer. It's based on all the facts and circumstances in each situation and allows the IRS to provide relief from a penalty that would otherwise be assessed. And the taxpayer must show not only reasonable without willful neglect. Next slide. So reasonable cause, so essentially these are some examples. So for example, their business records weren't available, or there was a fire, a natural disaster, tornado, death in the family, illness, incapacitation, reliance on a tax professional. We use that sometimes where, a client relies on the professional and then, it's not the client's fault. So these are just some reasons that we can use. And the requests for reasonable cause penalty abatements do have to be submitted in writing. The failure to pay does address, why a taxpayer hasn't paid, but just the lack of funds in itself is not reasonable cause for the failure to file or pay on time. But that can help us, why was there a lack of funds? And so here's one that I was kind of mentioning before, is reliance on a professional. So this is, the advisor was a competent tax professional who had sufficient expertise to justify reliance. The taxpayer accurately provided all the necessary information to the advisor. The taxpayer actually and reasonably relied in good faith on the advice received from the advisor. The advisor must be a person other than the taxpayer, and the advisor must actually render advice. So in this case, when we submit detailed information as possible, so for example, we want to know who the advisor was and what was their credentials, were they a CPA, an attorney? And so that the more details we can provide, the better it is that we can explain, and the possibility of abatement is better. So again, the penalty abatement request based on reasonable cause must be made in writing under penalty of perjury. And it's not unlikely that the first request for penalty abatement would be denied. And so it's very likely we do have to file an appeal. And like Ben mentioned, we do want to frame our request, our original request, kind of in preparation to go to appeal. So the appeals officer does have discretion in abating penalties. And it's appropriate when it is clear that the taxpayer did what an ordinary person would do, and after the error was discovered, it made every effort to correct the problem. So for example, if someone was embezzling or funds from the company, when did the owner discover it, for example, and what did he do to correct it? And that's important. The IRS wants to see that, and that also helps. So I guess I'm going to the polling question. The first time abatement requires a written letter to the IRS.
Sometimes those appeals officers don't know that they have discretion. Even when I read them the Internal Revenue Manual, they'll say, no, 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 I can't do that. And I'm like, it says right here that even if you think, even if the law like almost strictly requires it, you can, if you think that they did everything they could, it really wasn't willful, you can still abate it. But some of them don't ever want to.
So we got a response back. So the answer, the first time abatement requires a written letter to the IRS, is false, because we can request that over the phone. But reasonable cause does have to be submitted in writing.
Did I go too far, or is this the right slide?
No, this is good.
Okay.
So passport revocation. So we're switching gears now. So the IRS certifies seriously delinquent tax debt to the State Department. The State Department will not issue a passport, may deny a passport, or revoke a current passport after receiving certification. So under the law, after the IRS certifies a tax debt of greater than $53,000, the Treasury will transmit certification to the Secretary of State for passport revocation or denial. But the good news is some tax debt is excluded as seriously delinquent. So next slide.
This doesn't matter as much now since nobody can go anywhere, right?
Right.
How's it not going? Let's see. Oh, I was gonna go too far. There we go.
Okay, so so what happens in this process? So basically the IRS sends a letter to the taxpayer letting them know, hey, you're seriously delinquent, you owe over $53,000, so they'll break down the balances. Usually as a power of attorney, we do get copies of all the notices the IRS issues, except for this one. The IRS will not send a copy to the power of attorney. So we want to make sure all our clients are sending us letters that they're getting, especially this one, because it does require a response. So before denying a passport, the State Department will hold the application for 90 days, and this allows the taxpayer to either resolve any erroneous certification issues, pay the full amount due, or enter into a satisfactory payment plan with the IRS. Reversal of certification, that's if the tax debt is paid in full, or no longer the statute of limitation expires, or the debt is no longer seriously delinquent. So I think one back then. Yeah. So, okay. So the IRS may ask the State Department to exercise its authority to revoke a passport if, so for example, if the IRS actually reversed certification because a taxpayer promised to pay and then the taxpayer didn't pay, the IRS doesn't like that and will say, hey, State Department, revoke the passport. If a taxpayer could use offshore activities or interest to resolve their tax debt but chose not to, and before the IRS sends a revocation referral to the State Department, they will issue a letter, and again, we have 30 days to respond to that. And erroneous certifications, the taxpayer does have the ability to file suit in tax court or U.S. District Court. So next slide. So this here is the good news, because if the IRS will not certify to the State Department if, for example, taxpayers on a payment plan, if they have an accepted offer in compromise or a settlement agreement with the Justice Department, if they filed a timely request for a collection due process hearing, it says levy, not lien. Collection has been suspended because of request for innocent spouse relief. Taxpayers in bankruptcy. IRS identified taxpayer as a victim of tax-related identity theft. Taxpayers in currently non-collectible status. Taxpayers in a federally declared disaster area. Taxpayer has a pending offer in compromise with the IRS. IRS accepted adjustment that will satisfy the debt in full. So now switching gears again. So this is Ben.
Sorry, my mute button moved, so I couldn't find it. So I guess it's good that I skipped to the second slide. I'll go back to the first one. This is the BBA, or the new partnership audit rules, that have really came into effect January 1st, 2018, for those returns that were filed then. Just the things you need to know. I mean, this goes over, if you get these, you can go back over any of this you want to. The main thing you need to know are these 3 options here. We're just starting to deal with these in audits. We have a few BBA audits now, but the first and most important thing is every year, if your partnership is subject to these provisions, you got to opt out if you can, and make sure that's done every year on the return. Now, I don't see a reason why you don't opt out, because we have, in every instance where we have been audited, you get a chance at the beginning of the audit to opt in if you want to. So, so you should opt out, because then you don't have any options, right? Because you can always opt in if you do get audited. So we have, in some instances, done that, and mainly because we're thinking through on these possible adjustments. If there is what they call an imputed underpayment, which is basically an adjustment to the partnership, there's 2 options. The partnership can pay, which is basically they figure out what the adjustment would be, and they apply it to the partnership at the highest rates, tax rates. But you can go through this process, which we haven't done one yet. We're kind of going through one now, where you're basically showing them what all the effects would be on all the different amended returns for the partners, and then you can say that, well, look, we should get these lower rates. You might have a taxpayer that's tax exempt or something like that, and you want the IRS to acknowledge that instead of applying the higher rates. So you can go through that process, but it does say it's subject to the IRS's acceptance, so we're not sure what that entails yet. So then there's the push out. So that's option 3. So basically you can force this push out process to all the partners. And there's also all this, basically you have to work out with the IRS, and they have to approve it too. So I don't know that any of it's really at this point advantageous or it's kind of going to depend on the agent and how they interpret these things, and how the old TEFRA advisors, now BBA advisors, interpret them. Back to you, Margarita.
All right. So, okay, so IRS launches Identity Theft Central. So, I mean, given the times and technology, a lot of identity theft is going on. So essentially, the IRS will either reach out to the taxpayer, kind of notifying them that possibly they received a suspicious tax return, and they will send a letter to the taxpayer to kind of verify their identity. So the taxpayer has a certain time to contact the IRS, try to correct that. If it is suspicious or a fraudulent return, then taxpayer will be given a PIN number, and they would have to use that number when they file future returns. The second situation is now the taxpayer is a victim of identity theft and then contacts the IRS to let them know. So for example, like in Oklahoma, there were a lot of false unemployment claims being made. So that taxpayer has to notify the state, but then it's advisable to also notify the IRS that someone has used their identity. And the last part is the Identity Theft Central. So the IRS is, recognizing that this is an issue. So they've launched a website, and it basically provides a lot of resources for taxpayers.
Yeah, and this has caused lots of problems when you get duplicate filed returns and yours is the correct one, it gets rejected, you don't get your refunds, or payments don't get applied to the next year, all kinds of messes. So it's important to take care of this up front.
Right. So okay, switching gears again. So 10 things you need to know about IRS audits and appeals during COVID-19. So essentially there's no new audits in general, unless statute of limitations is expiring or the taxpayer basically comes to the IRS through voluntary disclosure practice cases, claims, or other pre-refund verification programs. LB&I auditors may expand existing audits to new years with manager approval, and auditors can work on new cases without opening an exam. So it's kind of like they're pre-planned, but they will not contact the taxpayer at this point. So next slide. So number 2. So open audits continue. So current audits proceed without in-person contact. LB&I will continue with their audits. If statute is expiring, IRS will take necessary steps to protect the statute of limitations by requesting extensions and issuing notice of deficiencies. And again, LB&I may expand existing audits to include new years and may expand existing audits. Let's see. Yeah, I said this already. Include new years with manager approval. Okay, so number 3, IRS will examine and process taxpayer-initiated actions. So again, if a taxpayer kind of approaches the IRS for a refund claim, then or voluntary disclosures, the IRS will start that.
Not if it's on paper, though, right?
Right. Well, all mail has been delayed, and some service centers, well, most service centers are still closed. So, yeah, that would just be sitting there for now. 4, IRS evaluating campaigns to postpone. So LB&I is assessing existing and new campaigns to determine which will be postponed. Campaigns that will continue are the syndicated conservation easements, micro-captive insurance, transition tax, and other future campaign related to Tax Cuts and Jobs Act. So 5, taxpayers have extra time for key audit and litigation deadlines. So this is very important. Essentially, the deadline is July 15 for time-sensitive issues. So for example, filing tax court petitions. If it was due, for example, April 1st, we have until July 15th to file that petition. One of the reasons is the court is actually closed also and not processing the mail. So, but that's important. So if you have clients out there that has got a notice of deficiency and the date has passed, we can still file a petition. Filing for review of a decision rendered by tax court, filing a claim or credit of refund. So those deadlines have been extended. Number 6, IRS also has extra time for key audit and litigation deadlines. So the IRS has an extra 30 days to perform. So if something was due after April 6 and before July 15, they have that time frame. And this includes assessing any tax, giving or making notice of demand for payment, and bringing suit to the U.S. By the U.S. and allowing credit and or refund of any tax. So number 7, LB&I has suspended its IDR enforcement process generally. So they're still working the case behind the scenes. They just can't enforce. They can still issue the IDR and enforce it. And number 8, IRS accepting digital signatures. So right now we can send e-signature. That's until July 15, but any tax returns do need original signatures. Next slide. Oh, number 9, auditors and appeals officers allowed to receive and send documents via email. So of course they want you to send it through other methods if possible, but given that they're not getting mail and a lot of them are working remotely, they are accepting emails. And number 10, appeals conferences continuing via phone and video. So they're not having in-person meetings, but they're doing phone and video. So next slide. So something that's coming out this summer is actually the IRS is going to start accepting amended tax returns electronically. So they're just doing it now for the 2019 tax year, and they're doing it for individuals. So 1040X. Obviously, this would allow the IRS to process the returns faster. It gives, when we call the IRS practitioner priority service, they'll have more complete and accurate information. Again, it applies to 2019, 1040, and 1040 SR. But taxpayers still have the option to paper file, and the IRS is offering an online tool so you can check where's my amended return. So that is it, unless anyone has any questions.
I forgot to mention, so I'm located in Utah, but we work for all of our offices, and we're basically all west of the Mississippi, and Margarita's in California, but we're all in our houses right now, so Margarita might be there for a while.
Yeah.
All right, guys. Well, I don't see any questions coming through. So thank you so much to all of our attendees, and thank you to Ben and Margarita for presenting. I hope you guys have a great day.
Yes,
Thank
thank
you.
you.